All right. You can take
Okay.
over the screen, P.
Oh, one sec here. So I think the question had to do with this tab here, trade ideas from the main menu. So you see you have different tabs to select from up top. So on the trade ideas here, it's a tool to kind of quickly scan and do research and find if you spot anything interesting to, go and look further into. Um, and right now, I'm on the custom tab, but you could look at the most active options. So these are the stocks with the most active options. You could see Apple, Nvidia, Amazon, Tesla, SPY. And if you click on them, right, like this, you'll get. So I clicked on Amazon, and now Amazon popped up. Here we get some stats on Amazon stock. And then we get these trade idea cards, and they are defaulted to the top three by theoretical edge. Okay. We could look at just bull call spreads, for example, or bear call spreads. So if you're looking for like a bullish idea, you might want to take a look at a bull call spread or a bull put spread, credit spread. If you're looking for bearish ideas in Amazon, you could do a bear call spread or a uh, bull or bear put spread, right? So nothing popped up there. So it's a quick way to kind of scan for certain strategies in these top most active options. Okay, the top securities with the most active options. And when we look at the trade card, we get some details here um, about the strategy and the analysis behind the strategy. So in Amazon, we have three different strategies here. One's a long put, one's a long straddle, one's a long call. They were filtered out because of their theoretical edge. And what do we mean by that? Well, here's a long put. Here we got because of the theoretical edge. So we're looking at over here the 197.5 strike option that expires July 12th. So 2 days from now. The market price when we took that snapshot was $1.14. So that's what the option price was. And of course, we don't know where Amazon's going to go up. It could go down. We don't know the direction it's going to go. But if we're bearish, and we're looking for a bearish idea, one strategy is long a put, right? Or long a put spread. So we got this put here. It's $1.14. That's the market price. And we want to compare it to what do we think a good benchmark is for the value of that option, right? Because if it's $1.14, the question is, well, is it relatively cheap? Is it relatively expensive? Is it right in line? And we have to kind of come up with a methodology or a model to give us a benchmark, right? So there could be different models. Keep in mind, there's no one exact right model to put a value on an option, but we could use our historical data to come up with a theoretical value. And in this instance, we're looking at the historical return distributions of the stock. What did the stock tend to do historically in a similar situation? In other words, if it's 2 days to expiration and looking at the volatility, does it have earnings, not earnings, so it looks through that and then says, how did the stock behave? And it measures, from over that 2-day, because in this case, it's going to be like a 2-day period. It's going to go and look over a 2-day period. How did the stock behave? What kind of returns are we looking at? And then based on that, we could figure out on those returns, if it did it again, what would this option be worth? Right. So if, for example, the stock's 199.34, if in 2 days it's unchanged, right, then we know that this 197.5 put is worth 0. And we go back in history, we look at those observations, and then we take an average value and say, okay, this is what the historical average value is over time if the same strategy was repeated over and over and over. And that's this price, $2.22. And that appears that then this put is not expensive from a historical perspective, from a historical stock behavior perspective. Right? It's that it looks like, yeah, the option could definitely be higher. And here we see that if we just compare these two numbers, $1.14 versus 222, well, it's a pretty big discount, right, to 222. You're looking at if we use this as the long-term average, 222, then you're looking at a 95% edge, right? If the long-term average going forward looks anything like it did historically, then it looks like a significant edge. We don't know what it will look like going forward. Maybe we'll adjust our model based on other factors, but this is our starting point. Well, let's look at what data we do have, run a theoretical value, and then look at the market price versus that theoretical value. Then we also have a historical win rate, which says, okay, yes, the average is 222. But the average could be skewed. It doesn't mean like that all the returns are clustered right there. You could have a bunch of zeros, and then one time it could be worth $20. So the idea then is, well, if we're looking at $1.14, right? So for $1.14, we know that in 2 days, Amazon has to go from 199.34 at expiration. It's got to be below 197.5 for that to have intrinsic value, but it's got to cover the cost of this, so another $1.14. So how often, right, did Amazon actually move that way that the stock ended up being below the strike price plus the premium of $1.14? So percentage wise, how often did that happen to make this put profitable, right? To make this put profitable at expiration. So we're only looking right now from now to at expiration. What's the probability, right? The historical probability. And our data that we use shows that happened 33% of the time. One third of the historical data shows that the stock moved in a way that made this option profitable at expiration. Okay, so we got those two numbers now. And basically this we're doing similar for straddle, long call, and all these other strategies. Okay. Now, if we wanted to just click on a report without going to the options chain to analyze it further, but we just wanted to see some more information, statistics on Amazon, we could click on this report, and it's going to load up the Amazon. Here's the put. And then if we click on these tabs, it gives us more information. Right. So here we see Amazon 199.32. If we look at the 197.5 put, it's $1.14 debit, expiring July 12th. So in the first part of it, we could just look at the stock behavior from different perspectives, just to get an idea, like what has it been doing lately or the most recent history. So we could see over a 1-year period, their relative performance over a 1-year period, Amazon has outperformed the market. So we could look at it here. Amazon last year returned 53.6% versus SPY 28.3. So it looks like it's got a pretty strong performance on a relative basis. Right? On a relative basis, it's done better than the rest of the market. What about if we get closer, let's say 3 months? In the last 3 months, it's underperformed the market. Right? So here, it's telling us in the last 3 months, well, here almost the same. Amazon returned 7.4% versus the market 7.4%, but there could be a slight difference there. So it's underperformed slightly. And in the last 2 weeks, so we got these three. In the last 2 weeks, it has outperformed. So it still seems pretty strong in a longer term, like 1 year, 2 weeks. It looks pretty strong. Just in the last 2 weeks, it outperformed the market rate. So Amazon's up 7%. If we look at SPY, the S&P 500 is up 2%. So that's definitely outperformed the S&P 500. Let's look at it from another perspective. Well, what about seasonality? Should we be looking at the date range that the stock's going to trade in between now and expiration? And historically, is that tend to be strong or weak? So for any reason, we could investigate that if something jumps out. Here, it says that at least historically, if we just look between July 9th and July 12th, right? So we're looking at historical calendar days, not 2 days, but historical, just July 9th to July 12th last year, July 9th to July 12th the previous year, July 9th to July, and so on, to get a seasonality statistics. And here it says in the last 12 years, Amazon increased 75% of the time for an average gain of 1%. So at least in the seasonality analysis, it looks like it would be more bullish from that perspective. And then finally, we're just looking at a technical indicator, and that's our indicator where we compare the moving averages. And we say, okay, well, where's the stock relative to its moving averages? Where's the 20-day moving average versus the 50 versus the, how do the moving averages look? Because that's one way to try to determine if there's some kind of a trend, right? Look at the trend. So here, right now, we tagged it as Amazon is on an uptrend. Okay. And we could go look at the chart, but basically it's saying that all the moving averages and the stock, are crossing in a bullish way. Okay. So that's the stock really quickly. And we could close that out. We could open the payout diagram, and the payout diagram just shows us what the option would look like at expiration. So you could see here's the current stock price. So if it remains here, this option is gonna expire worthless. It's gonna, and there you're gonna lose that $114. There's like your break even, and then And then after that, it's going to move one for one with the stock. So here your break even is 1.5% away. You need it to move down 1.5% to break even at expiration. Below that, then it will be profitable. Okay, and that's your max loss 114. Let's close that out. We look at the analytics of the option just to explain it, but we already did with the debit, 222 theoretical value. So we just explained all of this part, but you could read it in here. The takeaway here just kind of sums it up, right? Just looks at, well, this is a bearish strategy, and we got 1, 2, 3, 4 out of 6 analytics on how the stock behaved, point to bullish, 4 point to a bullish pattern to a bearish. Okay. And then you could read this further. Let me close this. There's always things to consider. So this is kind of just a quick reminder. You should look out for any type of news, different market conditions, or volatility is going up, down, or things happening in the market that could factor into it. Keep an eye out for events. So there could be some events coming up that you want to be aware of that could cause the stock to move at a more volatile pace. Keep an eye on the bid-ask spread. So when you're doing an execution, you want to be aware that the distance between the bid and an offer, right? The width of the spread factors into the quality of the execution. The wider it is, and the cost of executing could increase. And you want to see if you could get a better price. So keep in mind the bid-ask spread. There's early exercise risks. So these are just kind of like reminders of things to consider. And then you've got that trade card here, which is kind of just repeating. So I'm going to close this real quick. And let's say this is something we want to analyze further, the long put. You could click on this blue options chain arrow. We'll go ahead and do that. And what this will do is take us to the options chain for Amazon, populate that strategy on the options chain. So I'm going to close this menu just to expand it. And you see buy the July 12th 197.5 put for $1.14 because that's where it closed. So it's looking at 197.5 put. You could see here 111, 114. And by the way, this is July 12th. So if you look on the left-hand side of the options chain, we do have little indicators like a C here, an E here. If we detect some event that we think that covers that expiration, we'll put that indicator here for convenience. So here you got July 16th. There's going to be Prime Day event, 10th Prime Day event. I don't know if that will impact it, but something to potentially look at. We're estimating in earnings. That's what the little star is, July 26th. That could cover that expiration. So now that we have this July 12th put here, we could run the analysis, and then we'll get more statistics on it. So here we kind of have the historical return distribution. And this will show us, again, based on the settings I have on here, it's going to create a theoretical value for this option based on number of years of history you set and so forth, which you could do from here. In here, distribution theo. but let's keep it on here for now. This is saying that there's a $1 theoretical edge because if it's the value is 222.21, the option is 114. There's a big difference there. Historical win rate 32%. Probability of touch, that's looking at the history and saying, well, in the 2-day period, right, the stock could move, you know, up, it could move down, and then at the end of 2 days, it could end up somewhere in between. So historically, how often did it move enough, like if it was expiration, enough to cover the cost of that premium and be to break even, right? And that happens 63% of the time. So this 32% looks at, you know, from the start to the end, right? So 2 days from the start to the end, 2 days. This looks at the values in between, from the start to the high and to the low. Okay, and how often did it hit a price enough to cover this cost? That was 63%. And then this looks at it from another model. It says, okay, we could look at the historical stock returns. We could also look at the historical implied volatilities and put those inside an options pricing model. And just based on a 2-day hold, right, over options similar to this with 2 days to expiration and you know, similar distance away and other circumstances it looks for if there's earnings or not. And then it says, okay, plug in the average implied vol and give me a theoretical value. So the average implied vol will give us a theoretical of $1.45, which is higher than $1.14. So there's a theoretical edge. What is the median? So that's where half the observations are above, half below. That'll give us a $1.25 theoretical edge. And what is the range? Right now, it's like, well, what is the low and high range? You know, using the lowest implied vols, highest implied vols. So 89 cents to 503. So we could see here it's on the lower end of the historical range. But we're up at 9:30, so I'm going to stop right there.
Yeah, D, great job, Rob. Hopefully that was helpful. Certainly super interesting, D. Thanks so much. Again, tomorrow, I don't know if anyone was able to catch yesterday's stock burst episode on IBKR. It was a great webinar, D. I'll put the link to the YouTube, or excuse me, the IBKR library. That was our actually 33rd webinar you've done with them. So I'll put that in, and anyone can go to that. You just have to register with IBKR. Just a reminder, tomorrow and Friday, I am off on a family event. We will be back on Monday. So great job, Dima.
Okay, yep. Thanks, Will. All right. Everyone, I guess, have a great weekend because we're not back till Monday. Stay safe out there. Have a great trading day. Yeah, we'll hope to see you guys on Monday.
Trade in peace, everyone. Have a great